Hello and welcome. My name's Elliot Gu. I'm co-founder and chief analyst for Deep Dive Investing, and welcome to the Deep Dive Investing YouTube channel. Earlier this week, on Monday in fact, I posted a video on this channel talking about last week's employment situation report, which many of you know is probably one of the most widely watched pieces of economic data that comes out every month, saying how many jobs were added or lost in the U.S. economy, other factors as well, like average hourly earnings, etc. And the kind of primary narrative, if you will, that crept into both the mainstream media but also the financial media was that the very strong employment situation report, and by very strong, most people were looking at the headline gain in non-farm payrolls, which is much larger than had been expected and appeared to reverse a trend the prior month of a very low gain in payrolls. So the idea was that this report was very strong, and therefore the Federal Reserve, was less likely to cut interest rates at the end of this month at their meeting on July 31st. And what I said in that video, in short, of course you can watch the full video for free on this channel, but what I said in short was basically 2 points. First of all, I have no idea why the non-farm payrolls report is given this sort of aura of importance more than almost any other piece of economic data. Obviously, in a country like the U.S., which is driven by consumer spending, it is important whether people have jobs or not. But the fact is, if you're trying to forecast the future for the U.S. economy or get a real read on what's happening right now, it's not a very good report to look at. It's really lagging data. The unemployment rate, changes in the unemployment rate, and changes in payrolls typically lag turns in the economy and aren't very good forecasters of recession or slowing growth either. But it does still seem to have this sort of vaunted view in the mainstream media, which I think is unwarranted. And what I said, though, is that I felt that the Fed understands that issue and that it wouldn't really impact their view on whether they should or should not cut interest rates at the end of this month. I said I thought they would cut interest rates at the end of this month. In addition, I took a look at 3 separate indicators within the employment situation report, going beyond the headline gain or loss in non-farm payrolls, as well as the unemployment rate, that actually are better predictors of the forward-looking health of the U.S. economy. And I said that if you look at those numbers, the report really wasn't all that strong. And I said for all these reasons, I felt the Fed would cut interest rates at the end of this month. And this week, though, we actually had Fed Chairman Jay Powell's semi-annual testimony before Congress. So on Wednesday, the 10th, he testified before the House of Representatives, and on Thursday, the 11th, today, as I'm recording this video, he's testifying in front of the U.S. Senate. This is, many of you may have remembered, this used to be called the Humphrey Hawkins testimony. It's a twice annual thing. Basically, it involves the Fed chairman reading a brief statement, a pre-prepared statement that's actually released before the hearing even begins, and then our elected representatives essentially asking mainly some pretty dumb questions of the Fed chairman and a couple of good questions mixed in there. So we had this, and this was widely expected to be Fed chairman's last real chance or highest profile chance before the meeting at the end of this month to give further guidance on whether market expectations for an interest rate cut were warranted and walk back those expectations if he felt like the Fed might not want to cut at the end of this month. Well, to make a long story short, he delivered a very dovish testimony by which it's almost certain now, based on his comments, that the Fed will cut 25 basis points at least at the end of this month. I think we will get a 25 basis point cut. Frankly, I think calls for 50 basis points are a little out there. You are hearing that in some corners, but I think we will get 25 basis point cut at the end of this month. But what I wanted to do is not just talk about that overall dovish tone, but I want to look a little deeper into his testimony at some of the key comments I heard. And I also think that some concepts that are crucial for you to understand as investors, for us to understand as investors and monitor as investors. And I also want to look at one particular asset that I think is going to perform well as a result of the testimony he gave and the trends that I'm seeing for the economy, inflation, and interest rates. So I think this is actually one asset that we've been recommending for some time now in Deep Dive Investing. Those of you who are already Deep Dive Investing subscribers will already be familiar with some of the points I'm talking about. For those of you who are not yet subscribers to Deep Dive Investing, we do though have a free webinar coming up later this month where I'm going to talk about in more depth some of the trends I'm going to talk about on this video today. I'm going to discuss that in more depth. If you'd like to join us for that webinar, again, it's totally free of charge. I'll leave the link to register in the description below this video. I would say though that our Zoom, which is our webinar provider, does limit the number of attendees we can have. I also don't like to get too many attendees on these webinars because I like to open it up for Q&A, for you to ask me your questions live on the webinar and for me to answer them. And if we have too many people on there, it just takes too long. There are too many questions to go through, and it becomes kind of unwieldy for me to run the webinar, frankly. So I am going to limit the number of webinar subscribers or registrations we get, but if you're interested, it is free. Just click on that link below in the description below the video, name and email address, and we'll register you for the webinar, also to receive the recording of the webinar. But today I want to give you a little taste of one of the trends I'm going to be talking about a lot during that webinar. So let's start off and look at some of the quotes I saw that were noteworthy in the testimony yesterday in front of the House. One congressman asked if Friday's jobs report had changed the outlook for interest rate cuts at the Fed. So this is kind of the question or the narrative that had been posited in the mainstream media. That jobs report was too strong, won't allow the Fed to cut at the end of the month. And basically, Fed Chairman Jay Powell came out with the most direct answer that he possibly could have, which is the short answer to your question is no. And that's actually a direct quote, pretty much what we predicted on this YouTube channel. Again, don't get too caught up in these narratives that go in the mainstream media and the financial media about one number changing the outlook for Fed hikes or Fed cuts. Usually not the case. And if you look inside the data, you'll see that it really wasn't as strong as some were saying it was. The second question I noted, which I thought was a very good one, I'm not going to go through all the dumb questions that were asked, just some of the smart ones. But one member of the House asked about the Japan experience. So many of you may be familiar, Japan was a booming economy back in the 80s. And then throughout the 1990s and throughout ever since the early 1990s, they've been struggling with deflation. So not inflation, but deflation. Central bank has done a lot to try to combat that, cutting interest rates to zero, quantitative easing, you name it. Even buying stocks directly, the central bank buying stocks to help prop up the stock market. And they've really struggled with this, and the economy has been very lackluster, kind of in and out of recession ever since the early 1990s. So the question is about what have we learned from the Japan experience? And the Fed chairman said that he thought there were a lot of lessons to be learned from the Japan experience. But one quote in particular really caught my eye. He said, "My main takeaway is honestly that the Fed needs to stand here and keep inflation symmetrically at 2%. And he also said, I think it's quite important that we fight at 2%, and keep inflation expectations up." So what does a symmetric mean? Well, many of you know that the Fed has a target of keeping inflation around 2%. The idea being that too high inflation is obviously a bad thing. We had that back in the 70s. But too low inflation, as Japan has experienced deflation in this fact, is also negative for the economy. So the Fed has a mandate of trying to keep inflation around 2%. Now, the problem is that the Fed hasn't been very good at meeting this target. Inflation has been pretty persistently less than 2% ever since the financial crisis, and has only risen above that level on the core number that the Fed looks at on a couple of occasions. And so what the Fed chairman is saying here is that target is symmetrical. In other words, when inflation is below 2%, the Fed might look to ease monetary policy or keep rates low to try to goose up inflation. And the other side of the symmetrical target is when inflation is too high, boost interest rates and try to push down inflation. Now, most people were already aware that the Fed's target means that inflation goes to 3%, the Fed's probably going to hike interest rates to try to push inflation back down. But what has been less clear is the downside of that target. In other words, if inflation is too low, the Fed is going to use monetary policy to try to push inflation back up. Now, one of the things that the Fed is examining very closely, in fact, they just had a big event in Chicago last month in June about this, is the idea of an average inflation target. So in other words, in a recession, inflation almost certainly going to drop below 2%, way below 2%, as it did in the Great Recession 10 years ago. And in boom times, it might exceed that target by a considerable amount. But if the Fed only fights higher inflation by raising interest rates and trying to get ahead of higher inflation, then over the course of a cycle, from recession to boom to the next recession, inflation is always going to average well under that target. And that's because, by definition, in those down times, inflation is going to be way below the target. And if the Fed's always fighting higher inflation, not allowing inflation to go above 2%, then on average, it's going to be way below 2%. So the idea that they're talking about, and they haven't implemented any policy change explicitly yet, although I think they are sort of in stealth mode, is that in periods of growth, they're going to allow the inflation rate to be well above 2%, and so that when it's below 2% in recessions, that the average over the course of the cycle will be around 2%. So that's what he means by a symmetrical target. I'm not in this video, and I won't in Deep Dive Investing either tell you whether I think that's a good thing or a bad thing. Not for me to decide. What I can tell you is that it means generally lower interest rates over the course of the cycle. If the Fed is not going to be as aggressive trying to get ahead of inflation rising above the 2% target, that means lower rates through the cycle. It probably also means that the Fed would rather see higher inflation expectations. In other words, people looking for higher inflation, more inflation in the system than has been the case over the last 10 years. So if we move on to the third quote here, someone asked, another representative asked, if there was a risk of having monetary policy be too hot. In other words, the monetary policy being too easy, too low interest rates, too much quantitative easing, too slow to raise interest rates. If there's a risk of that hot monetary policy causing excess inflation and a problem. And this is a common question that a lot of people ask. And what Chairman Powell said, which I thought was maybe his best one-line quote or his most interesting, revealing one-line quote, is he said, to call something hot, you need some heat. In other words, even though monetary policy has been very, very easy, sort of historically easy in recent years, we really haven't seen inflation rising even to the Fed's target. And I want to throw up a chart of that actually on your screen right now. And this is actually the measure of inflation the Fed favors. It's the price index within the personal consumption expenditures report. This is a year-over-year percent change. And what you can see here is I took this chart back to 2009. You can see that there have only been a couple of occasions where inflation has been above 2% on a year-over-year basis. Here in late 2011, very late 2011, early 2012, and then again in the middle of last year, I think for a month or two, it was above 2%. For this entire other part of this period, it's been below the Fed's target of 2%. So that's what he means by symmetrical. The Fed has a lot of credibility fighting too high inflation by raising interest rates to push inflation back down, but they aren't meeting their target on the downside. In other words, when inflation is below their target, they're not trying to push it back up. And Fed Chairman Powell believes that's a problem. Many FOMC members also believe that's a problem. And again, I think that means through coming cycles, lower interest rates in general, higher inflation and higher inflation expectations than what we've maybe become used to. I wanted to look at the trading action also in the Fed Fund futures market. The Fed Funds futures market, we can use the prices in that freely traded market to get an idea what the market's expectations are for rate cuts going forward. First up, I'm going to put up a chart. This chart shows the probability, and I took this chart all the way back to the beginning of this year, January of 2019. This is the market-derived probability of 3 or more Fed rate cuts by the end of 2019, by their final meeting in 2019, which is on December 11th. And what you can see is at the beginning of the year, all the way up until really May, the probability of a Fed rate cut, 3 Fed rate cuts this year was 0 to 10%, mainly closer to 0. Since the end of May, it's ballooned, right? So at one point there was the market was projecting more than 70% odds of 3 rate cuts this year, 3 25 basis point rate cuts, so a total of 75 basis point rate cuts this year. Right now the probability is somewhere around 55 to 60%. Yesterday a little over 60, today more like 55%. So not only is the market now projecting a 100% chance of at least a 25 basis point cut at the end of July this month, they're looking for a total of 3 cuts by the time the Fed meets in December, its final meeting of the year. Now let's look out even a little further into the future, and let's look at the probability, the market-derived probability of a total of 5 cuts, 25 basis point cuts. So that would be 1.25% cut to the Fed funds rate overall, basically a halving of the Fed funds rate because it's currently set at a target rate of 2.25 to 2.5%. So this would be a target rate half that, 125 basis points lower than it is today. And earlier this year, back in May, looking at less than a 6%, 5-6% chance that the Fed would cut 5 times between now and the end of next year. Right now, it's about a 1 in 3 probability the Fed is going to cut is 5 times between now and the end of next year. So the Fed, you may see this commentary out there that the Fed isn't looking to start an easing campaign. They're looking for just a couple of quote-unquote insurance cuts so that they're not behind the curve if the U.S. economy, the global economy weakens more. They're looking for insurance cuts, but the market's saying we're not looking for insurance cuts. We're looking for an easing cycle, 5 cuts, a halving of the Fed funds rate over a year and a half, basically 18 months between now and the end of next year. That's a pretty big easing campaign. So market expectations are for a pretty aggressive decline in the Fed funds rate, pretty aggressive decline in rates overall. And I also want to look beyond the United States because U.S. monetary policy has a big impact on what goes on outside the U.S. One reason being that if the Fed is hiking interest rates, right, that's going to tend to keep the U.S. dollar relatively strong, other countries' currencies relatively weak. Certain regions like Europe don't want, for example, the euro to strengthen a lot against the dollar because it makes their exports less competitive. And it would also really harm their economy, which is already kind of teetering on recession as it is. It's growing very slow pace. But when the Fed is cutting interest rates, that gives them cover, if you will, to also cut interest rates or ease monetary policy. So the ECB has already got interest rates pushing them below zero, negative yields, where you're actually paying a government to hold your money for you. They're also looking at maybe restarting quantitative easing in a big way. So this chart I'm putting up on your screen right now is actually a chart of the total amount of debt globally. These are bonds globally issued by governments primarily that have a negative yield right now. And it's over 13 trillion US dollars right now. You look at that, back in late 2015, less than $2 trillion of global debt had a negative yield. Today it's $13 trillion. Just since the end of last year, since the end of 2018, it's basically more than doubled from under $6 trillion to over $13 trillion. That is 24.1% of all government debt, sovereign debt outstanding globally. So this is pretty dramatic, I would say, that there's that much negative yielding debt out there. Interest rates are so low in all these developed countries, Japan, Europe, and the United States, and Europe and Japan having a lot of negative yielding debt. Super easy environment for monetary policy right now globally. So we have all of this easing going on around the world. We have a Fed which is now becoming more and more concerned about inflation, but not the way that you and I grew up with, where they were concerned about too high inflation. They're actually now concerned about too low inflation. You have a Fed that is likely to ease at least 2 or 3 times this year. I think if they did less than that, you would see the market sell off dramatically because the stock market is very sensitive to that. You saw that even the hint that they might not cut interest rates at the end of this month as a result of last Friday's employment report caused a big drop in the market, at least in the first part of the day. So interest rates are coming down globally. What assets benefit from that? Well, I think one of the biggest beneficiaries is actually gold prices. The price of gold, as many of you know, has recently broken out of a 6-year trading range, and I'm going to show you a chart of that in just a second. But first up, one of the questions I'm asked whenever I recommend gold, and we've been recommending gold, those of you who are Deep Dive Investing members already know we've been recommending gold for many months now. Our plays on gold, which involve both gold itself as well as, or ETFs that hold gold, as well as stocks that are involved in the gold mining industry or in the gold industry, have already done quite well for us. And I'm actually in the process right now of doing a deeper dive in gold. I'm almost finished writing up the issue, almost finished deciding on some of the recommendations I'm going to make. Those of you who are Deep Dive Investing members will obviously receive that as part of your subscription here over the next couple of days. But basically, I'm looking at 7 very specific trends that I'm watching that I think are all positive tailwinds for gold. 7 different trends. One of them is the inflation expectation issues that I just talked about, and there's another half dozen that I want to look at. And I'm also looking at adding additional gold recommendations to the Deep Dive Investing portfolio. I think this is going to be a long-term uptrend in gold, and I think that therefore what we're going to be looking to do in the service is I'm going to be looking to recommend incrementally adding to our positions in gold stocks. And I think it's very important that you be selective. Now, some people might ask, well, why don't I just go out and buy, gold, an ETF that invests in gold, which I think you should, and maybe a gold ETF that invests in gold mining companies. I think that is actually a very dangerous strategy right now. A lot of gold stocks out there, gold mining stocks out there, have some severe headwinds. Even though the price of gold is going up, these companies don't have a lot of new production coming online. They're dealing with declining reserves, declining production, and they're not going to benefit much from what I believe could be a significant rally in gold to over $2,000 an ounce over the next year and a half, even more maybe. These companies won't benefit that much. There are other mining companies that have more leverage to the price of gold. They also have more new mines coming on. That means that they're going to be increasing their production at the same time that gold prices are rising. That is a sweet spot. I can tell you from having analyzed commodity markets like energy as well for 20 plus years now that the best thing you can have is rising commodity prices and investing in a company that's showing growing production of that commodity in a rising price environment. So that's what I'm going to talk about in the issue. If you'd like to hear more about some of our recommendations, I'm also going to talk more about this in the webinar that you can register for in the link below this video in the description of this video. But I wanted to go over real quick what drives the price of gold. It's one of the most common questions I receive. What drives the price of gold? Is it the dollar? Is it deficits? Is it, what is it? And there are a lot of answers to that question. There are a number of factors involved. But historically, the single most important factor driving the price of gold is the level of interest rates and, in fact, real interest rates. What's real interest rates? It's a nominal interest rate less inflation. So in other words, if inflation is at 5%, if interest rates are at 5%, inflation's at 3%, the real interest rate would be 2%. If real interest rates, or if nominal interest rates are at 5% and inflation is at 5%, the real interest rate is 0. So when you have falling real interest rates, that tends to be positive for gold prices. Let me throw up this chart for you. This is a chart I created on Bloomberg. And what it looks at is over the last 5 years of data, what assets, indices are correlated most strongly to the price of gold. And I want you to look in particular at that top line there, that top line of boxes. There are 5 boxes there. And you can see the blue boxes are items that are positively correlated to gold, which means they tend to move in the same direction as gold prices. The first one being there is silver. The price of silver and the price of gold have historically been highly correlated, although I do think that relationship has been breaking down and may continue to break down near term. I'm not as bullish on silver as I am on gold. The Swiss franc has a strong negative correlation to gold. The Japanese yen as well have a negative correlation to gold. That means that when the dollar is weakening against those these are basically safe haven currencies, right? So when everybody's piling into those currencies against the dollar, when the dollar is weakening relative to those currencies, that tends to be bullish for gold. But the two right things there, the United States 5-year yield on 5-year government bonds and the yield on 2-year government bonds, you see those very strong negative correlations, meaning that when yields go up, the price of gold has a strong tendency to go down. So yields are the most important driver of gold prices. If you want to know where gold is heading and you understand where yields are going, those two things that's your game right there. Right now, as I indicated, I think real yields are heading lower, both because the Fed's going to be cutting interest rates and also tolerating or trying to tolerate higher inflation, meaning lower real yields. That's very, very, very bullish for gold. I'll talk a little bit more about why that is fundamentally in that webinar. Again, if you'd like to register, the link's below. Final chart I wanted to show you today. This is simply a long-term chart of the price of gold going back to 2001. And you can see back in 2001, gold prices around $250 to $300 an ounce. We got all the way up to over $1,900 an ounce in 2011. And then we saw a major pullback into that 2015-2016 period where we went back down to around the 1,000 to 1,100, 1,200 range. But if you look back to 2013, over the last 6 years, gold has been essentially trading in a range with the downside being around 1,100 or so, and the upside being between $1,350 and $1,375 an ounce roughly. We recently broke above that resistance level on the chart. Now, what you can see in this chart is in the first kind of half of this chart, gold was in a major uptrend. It actually broke above a long-term trading range which stretched all the way back to the late 1980s over this period and then saw a multi-year rally higher. This is kind of typical for gold. Gold, like most commodities, tends to move in multi-year trends. When it breaks out of a major consolidation phase, the trend lasts for a long time. That's exactly what's happening right now with the price of gold. We're breaking out of this consolidation period. I think this is going to be a multi-year trend. The time to get involved, though, is right now when the trend is still in its early stages. And a lot of these stocks and the commodity itself are actually pretty cheap relative to the fundamentals that I'm seeing. So that's my video for today. I hope you enjoyed it. I hope you found it useful. Talking a little bit about interest rates, Fed policy, inflation, and what I think is going to be one of the biggest winners over the next few years, and that is gold. I think this is a trend that's going to last for a few years now. If you have any questions, please feel free to pop them into the Q&A or comment box below this video. I do welcome questions. It really helps me decide, what videos I may want to throw up next. I do have some ideas for videos coming up, including one on oil, which I think you'll enjoy. Might be out over this weekend or early next week. But always welcome for suggestions or questions that can help me decide on what videos to cover next. If you haven't already, hit the subscribe button below the video and the little bell below the video to be notified every time I post a new video on this free YouTube channel. And last but not least, as I said before, if you'd like to join us later this month for the free webinar, and if you'd like to receive a recording of that free webinar, just hit the registration link below this video, sign up today, and I'll make sure that we send you the login credentials to become part of that webinar. There will be as well a Q&A session on that webinar. I'm going to talk about more specifics about how we're playing gold and how we want to play gold going forward. So thanks again for listening to me today. I hope you'll subscribe to the channel as well going forward. Thank you.